All right. Hey guys. Good evening. How is everybody? Um, Thanks for remembering 8 p.m. We did the poll last Sunday, asking whether people wanted to keep to a 9 p.m. live session or bring it forward a little bit to 8 p.m. And the votes from that poll was in the favor of about 47% people asking for us to go sooner at 8 p.m. Hence, while we're here this evening, 8 p.m. Let me just make sure I've got the volumes up here properly. Okay, cool. So thanks for being here. I'm good. Thank you, Abdul. I do have COVID though, so not great timing considering there was a lot of stuff on the schedule to do next week that I've been looking forward to and been preparing for a very, 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 very long time. So it's a very, very poor timing. But with that being said, though, um, my symptoms are very, very mild. They're not bad at all, to be honest. And yeah, I should be thankful of that because I am on the high risk, and it's just a shame. I avoided this for 2 years. Being careful, going out, doing my thing, and yeah, catch it a few days before I'm supposed to actually shoot for TV. It's very, 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 very disappointing. But there we go. All right, so I know that you guys are already in here at the moment. There are some questions already coming through. Thank you, James. Already do feel better, to be fair. Like I said, the symptoms have been very, very mild, so I'm feeling good. Um, I do want to touch on a couple of things. This past week has been quite interesting. I finally managed to get the video quality. I'm looking back at this feed right now, and I'm so happy. I'm so happy because prior, what I noticed was it was very, very fuzzy, almost pixelated, and I couldn't figure out what it was. In the end, I've had to have completely new broadband. So I'm pleased with how crisp this feed is now. And it doesn't feel as though it's lagging as much. So I'm very happy about that. We finally got it sorted. But I do want to talk a little bit tonight before we start going into questions about cost of living crisis, inflation. I think there's a nice segue of that conversation specifically to where we are right now with the markets. Um, but just ensuring that everybody's kind of like being pragmatic in the approach to this because it's very, very interesting to see the culmination of, the QE and, we talk about quantitative easing. I actually talk about this in the magazine that will be out this time next week. And but again, if you've not subscribed to the magazine, just head over to the website to subscribe. But essentially, we talk about quantitative easing being an unconventional monetary policy or monetary lever that the central banks have pulled through, obviously, COVID. One of the things that results or happens as a result of quantitative easing is high inflation. And I think that's where we find ourselves right now. When we were talking about inflation, back in November, when the sense was it was transitory, it will be something that will pass very, very quickly. And if you pay attention to the inflation forecasts, what we saw consistently was, well, we expect inflation to be at 5% by the time we hit April 2022. And you look at it right now, back end of January, we're hitting 5.4% inflation. And this is in January. With the energy price caps coming off, the cost of broadband and internet increasing as well later on in this year, what we now know is that inflation is more likely to be 7%. And that is a long way off the 2% target. It's over, three times the Bank of England target of 3%. And so what that basically means from a day-to-day monetary type of thing that you'll be seeing is that ultimately you'll be seeing your disposable income, if you're lucky enough to have disposable income, that's going to take a clip because your disposable income is going to come less. You're paying more for gas, electric, fuel in your cars, food, ultimately, and these costs are going to go up. So with that being said, what are the key things that we should be doing making sure that we've got covered. Yes, obviously, investing becomes a part of this conversation, because ultimately, one of the best ways for you to beat inflation would be to either have a look at a high interest savings account. That would be the traditional route. But what's happened over the last 18 months, where interest rates have been so low, is, well, you can't get anything in a savings account. So therefore, the next place that you will go will be into the markets. But the very news of inflation and all of the fears that are around that, interest rates increasing, and I will talk a little bit about Jerome Powell in a minute. I have a feature on him again in the magazine. Jerome on the 26th of January was he was very cute about not being definitive around what rate hikes will be coming on their side in the States come March. He said, "Yeah, we're going to be increasing interest rates. Obviously, we knew that they would have had to have done this months ago." But he's acknowledged, yes, we will be increasing interest rates. The markets didn't really like that, but when he was pushed and, I guess, asked directly, what rate are we likely to see interest rates increase by, he was very elusive when it came to that. So is it going to be 0.25%, like the Bank of England has just done this past week? Is it going to be 0.5%? Is it going to be 1%? The language used was, we will act accordingly. So at this point in time, come March, we don't know whether the Fed in the States are going to increase interest rates by 0.25%, 0.5%, 1%, or even more. We don't know. And that in itself, and whether the market has already priced this in, we don't know. But roll around in March, if the Fed decides that they need to push interest rates a little bit harsher and a little bit harder than previously anticipated, what is that going to do for the markets? I say that to say all of this. You wouldn't have gone to a high yield savings account because interest rates are so low, so you go to the stock market to invest. Investing in the stock market is great whilst there's QE, there's no conversations about inflation, increased interest rates, right, going up. Everything's buoyant. Plus you have QE, quantitative easing, pushing up asset prices. The market booms. Where we are right now is a completely different environment. We've got the environment where we do have these fears. QE is being tapered back, right? So they're no longer putting in 120 billion a month. They're tapering that back. By April, that's going to be completely dried up, which means that the markets are going to have to basically operate on their own steam, which is why we're seeing all of this volatility. Now, the question is, where is the normal operating parameters of the market? We don't know without the QE right now. So when we talk about investing to offset your inflation, with the investing space, due diligence, care, going back to the drawing board, making sure you understand what you're doing is very, 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 very important. There were already videos, talking about this is the bottom. Look, we don't know what is the bottom. We just don't know. And to a certain extent, whilst we cannot try to guess, whilst we cannot try to place a wager on where the bottom is going to be, we can be prepared for it. And again, that goes back to making sure that you know what your goals are. You try and review your plan, reassess your risk. All of these things are really, really important. If you're holding an individual stock portfolio that you've basically compiled over the last 18 to 24 months, taking stock tips here and there from different sources without really doing much of the research yourself, you need to go revisit that. Because the one thing you don't want, let's have a look at Meta, right? For the first time, Meta, Facebook, for the first time, a drop in users, all right? How much did it wipe off? I think it was like 30 billion or something like that. Wiped off because of that 25% plunge in value last week. Very, very uncertain times. Does that mean that Meta is not going to be here? Of course it's going to be here, but they are facing a lot of competition. And whether that continues or not, my experience of Meta and Facebook, they've got serious issues and they do need to sort themselves out. But what I'm trying to say here is we need to be a little bit prudent. So we're talking a little bit about that, and I'm sure that will come out some of the questions. But anyway, that's a monologue for you. I just wanted to put that out there just for some context to some of the things that I will probably talk about a bit later on. But let's get into these questions and see where this basically takes us. So the usuals on here: Food Dweller, welcome. How you doing? PM, how you doing? Abdul, JK, Michael, how you doing, mate? Right. Okay. Let's have a look at this. Swift Games. National insurance tax going up. No surprise there. Then cover all. I mean, that's something that I didn't even mention. National insurance. National insurance is going up as well. So it feels as though it really does feel as though if you're not the kind of person who's lucky enough to have any disposable income, because there'll be plenty of people across the country that come April and come these energy price increases, it's going to push you into the red. And this is even more reason why it's the basics. You need the foundations in place, right? You have to absolutely have to go and have a look at your budget now. You need to sit back down with what you've got coming in, what you've got going out, and if there's stuff that you don't really need, that you're not getting value from, that you could do without, you need to cut that right now, because that could very much be the difference between you being okay on a monthly basis in terms of having not being in the red. I was going to say having enough, not going into the red, because that's the worst case scenario, right? You go into the red, then God forbid you've got to use overdrafts, credit cards. You've got to start using things like payday loans. The basics around budgeting, very, very important right now. And that means sitting down with your bank statements, sit down last 6 months. Are there subscriptions in there that you just simply could do without? I mean, I was having a conversation with Sky, because obviously I needed to change over my internet. It turned out in the end, after they spent like a month and a half, 2 months trying to diagnose whether I had an issue with my line, the final recommendation was, upgrade your package. And they said to me things like Netflix, for example, you can get included with them at Sky. So it's taken a pragmatic view of, if you've got certain like subscriptions, Spotify, Netflix, or anything like that, that you could get as part of an existing service, you need to seriously be thinking about that, because it might be something as small as £9 a month, but ultimately those things add up. I mean, if you're seeing your weekly food shop go from £100 to £130, for example, if you're able to save 30 quid, even 20 quid, even 10 quid a month actually on a Netflix subscription, that's still putting money back in your pocket. And I think it's these pragmatic steps that we need to be mindful of. I mean, those are the things that we can control. Things like emergency funds, absolutely crucial. Right now, absolutely crucial. If you're going to be making large purchases, do you have to make them now, or can you just hold off to them? I would say in times like this, cash really is king. And even when you start looking at it from an investment point of view, where you're going to put money, cash right now is king, because if the market does end up being in a state of a real correction, you're going to want to have cash available to put money into the market. So cash right now is really, 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 really important. Cheers, James. Zazu. Yes, sorry that you got it, mate. Cheers, mate. I appreciate it. Like I said, I'm okay. Um, my throat, my voice was really, really coarse. Like on Friday, I was struggling on the live. Actually, it was day before yesterday, the live that we had with Chris Etherington on crypto and tax. I was struggling on that, really, really struggling on that. Yeah, but we must soldier on, right? Cheers, Naeem. Right, let's have a look at this from Abdul. Firstly, thank you for answering all my questions substantively over the past few weeks. It's greatly appreciated. Which top 5 robo advisors, fully managed platforms do you recommend, i.e., Money Farm? Okay, so there's quite a few of them, mate. The ones that I've reviewed and the ones that I guess that I've used, I would probably... So honestly, Money Farm have done well for me. They've done very, very well for me. So obviously I would suggest one of them as being on my top. I've used Moneybox in the Moneybox in the past. They were okay. I mean, they're great if you just want to be able to round up your transactions and you just want to be investing, a pound or something like that. They're good. They're okay. I think they are a little bit more expensive, and I don't think the service is as I guess, as easy as the likes of Money Farm. Like, it's not the same. Who else would I say? Who else would I say? Who else would I say? Nutmeg's pretty good. The way they explain stuff is really, really cool as well. Wealthify, very, very good. Um, Actually, watch the video on Tuesday, guys. I'm giving an update on Tuesday, um, and there is some news actually on Tuesday. So stick around for that on Tuesday. But Wealthify is also a very, 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 very good brand to use for that. The way they present their information is very, very good. And I said that in my first review video for maybe about 2 years ago. I looked at them, reviewed them, and I just love the way they made things simple to understand. So much so that in my investment course, they're kind of like the provider that I chose. As if you're just starting out looking to invest, you wanted to choose a provider that you could go to the website, see information, and not be confused because of the way they put things across. I thought Wealthify did the best job in terms of keeping that information very, very simple so you could actually make a decision to invest without second guessing and being confused still. So yeah, they're not five, maybe three. Well, actually, yeah, maybe three that I've just mentioned there. This is a follow-on. I mean, do I have a fully managed? Do I have fully managed platforms? I do. I do have fully managed platforms. I mean, like I said, I mean, look, you've heard me speak about cost all the time. I mean, cost is obviously a consideration for me, but it's not my main selection criteria. When I select companies, it's all about whether they have the ability to perhaps deliver the things that I need them to deliver. And a lot of that has to do with the kind of funds they have available, the service as a whole. Me doing a little bit of research on on the company itself. I mean, one of my benefits, I guess, is that this is a very small industry, so inevitably, someone I know will have worked at a company that I may be reviewing. So I have kind of like an experience, even just from an employee's point of view, what they're like. And that's really important, actually, to be fair, because if a company treats their employees really, really well, then it's likely that the employees are going to care enough to provide a really good service. So because I've got a little bit of insider, I won't say insider information, but I have the benefit of knowing people in the industry, I guess I have a better view. So I don't always go on pretty much just cost being the main driver. It is all about the investment proposition, the skill set, teams, all that kind of stuff. Past performance, yes, I'll compare it. It's no obviously indication of future performance, but yeah, how have they done in a really rough patch when the markets were down? Have they performed well for their customers, or did they just not perform well at all? Those are main drivers for me. I don't mind paying fees. I'm very, very busy, so looking at a stock portfolio consistently is not really something that I want to be doing. And I do that obviously with my individual stocks, but even where that is volatile at the moment, and because my short term goals have moved and they have been moving really for the last 12 months, I've taken time to actually review and reshape that individual stock portfolio as well. And I'm going to be reallocating money elsewhere at some point. So, yeah. Well, let's have a look at this one. With high inflation, I sold many stocks, in particular tech. Cash account over 50% to buy into market crash. Is there a follow up to that? One second. What's your thoughts on What's your thoughts when the correction could happen, mate? I have no idea. Give me a crystal ball, and I'll be able to tell you. Bring me a sports almanac, I'll be able to tell you. What I do think is that we're in for a lot of volatility. Um, there's going to be a lot dependent on what the Fed does in terms of their move come March with interest rates. I mean, they were talking about unemployment numbers in the States and how they didn't quite meet the targets that they hoped they would actually meet. I mean, I know the Fed and Jerome will be looking at that specifically. So if they have really poor unemployment numbers again in, say, February, that's obviously going to dent confidence because unemployment numbers are important for obviously other metrics within the whole economic stance. So if they don't hit employment numbers or they don't have great employment numbers, and we get round to March and their inflation number jumps up even more, and I think their inflation number, I believe, was around about 7% anyway. Then come March, we might see more drastic measures than are being anticipated right now. And if that is the case, then will the markets then spook and have another full sell-off, or go into proper sell-off mode, participate in this correction? I just don't know, mate. I mean, we can speculate these things, but we don't know for sure. If you've got money in cash, though, waiting for this to happen, I think if you've taken out profit with under the assumption, or with the understanding that there could be a market correction, I don't think there's anything wrong with that. Um, the big thing is, when are you going to deploy the money into the markets? We can't time this stuff. I guess the only thing you can do is make the best educated guess that you can, knowing that it's either going to go one of two. Well, it's going to go one of two ways, really. One, you could put your money in today and goes down a further 10, 20%, 5%, whatever that amount might be. Or actually, it doesn't, and you get it right at the bottom and it rebounds straight back up. It's 50-50, mate. We really, really don't know. If we could tell this kind of stuff, we'd all be billionaires and trillionaires. But if you've got money set aside, then, you know, keep watching the markets, mate. Keep watching the markets, do your own research, and make a call based on your own convictions. And just know it's 50-50, 50-50. You get it right, you get it wrong. I mean, I even get things wrong sometimes as well. And, it's not nice, but ultimately, you wouldn't mind getting things wrong if you're diversified. If you know that you've got other monies doing other things that actually, you know what, it doesn't really matter what's happening here. If you're looking at it for 100% of all your money, then you need to be very, very pragmatic and sure of what you're doing. But diversification is very important in these times like this. Walter, no worries, mate. Thanks for starting the stream earlier. Makes it much easier to catch it live. Hope you feel better soon. Yeah, cheers, mate. Appreciate it. Carly, how you doing? Hope you're well, mate. All right, so here's one from Pete. PM. I've got 50k in cash, ISA, and I'm seriously considering paying my mortgage off in full, just to get rid of the stress and worry. Mate, listen, you need to do what will help you sleep better at night. If paying off the mortgage, so you've got no mortgage, no debt, zero debt, like your mortgage is oftentimes your biggest monthly expenditure, right? If that's going to make you sleep better than having it in a stocks and shares ISA, where we're potentially going into a market correction, a lot of market volatility, mate, then by all means pay off your mortgage. We can have the conversation around, well, how much are you paying on the mortgage? Is the interest rate this? And what could you get from the markets? That's a scientific answer, which has numbers behind it if you really wanted to get technical. But what I say to people is this: personal finance is personal. You have to do what you feel is right for you. So if in your mind you will sleep better at night knowing that the house is completely paid off and you have no worries whatsoever, that's what I would do. You've got to do what will make you sleep best at night and essentially give you peace of mind. And for a lot of people, they will argue that the markets won't necessarily give you peace of mind, with all the news and all the stuff that's out there at the moment. So yeah. Good question. Do I think a property crash is coming? A lot of people are talking about it. I mean, look, potentially the property market could crash, could correct alongside the actual stock market. That is a possibility. It is a real possibility. Will it happen for sure though? I don't know. I mean, I can't really comment much on the property market because I'm not really in that space myself. I know that people are talking about it, but it is possible that, yeah, we could see a bit of a crash in the property market specifically. Um, it's anyone's guess, really, mate. I can't really give that much of an insight or provide that much nuance or kind of different thought or an in-depth look at that because I don't really work in the property space. But it is possible that it would happen. I mean, you need to think about really. I mean, obviously with property, it's supply versus demand. Obviously, that is always going to be a main factor in there. But you need to think about all the other contributing factors that could lead to a market crash. Yes, interest rates will obviously dampen the flow or the appetite of people willing to take on debt. I mean, it's very, very easy to buy properties when debt is very, very, very cheap. So you can go and get a mortgage, 1.49% or whatever the numbers might be, locked in for 5 years. Yeah, 1.79% locked in for 5 years. It's very, very different when you've got to go 3% for 5 years. People will think twice because it's going to cost them more money to take on that debt. So, and this is partly what has been driving, the market prices, the house prices, the fact that debt is so cheap, with interest rates likely to go up. People are going to people are going to second think that the decision to actually go and buy something at higher rates. So that will probably have a bit of an impact. Absolutely, for sure, it will. But who knows? And you got to think about all the affordability as well. If it's going to cost you more money to actually purchase a house, to actually borrow that money, you're being squeezed when it comes to energy cost. We're probably going to see council tax and all that increase again this year. So all of a sudden, your earned income, how far it goes, is actually going to be squeezed and squeezed and squeezed. And when you start talking about mortgage multiples, so if you're earning 20 grand a year or 25 grand a year, because that's the minimum you need for a mortgage, you times that by 4 or 5, or if you're with Habito 7%, by the time they go through all the affordability and the stress testing, once they factor in all of the new billing, the energy bills, the new costs, and forward plan for that, stress test that, you may find that actually some lenders will tighten their lending criteria. So those individual things could potentially mean that you'll see a slowdown in the property market. But does that mean we're going to see a correction? We're going to see a crash? I don't know. But there are certainly factors that could impact it. Can a Nasdaq 500 and can a Nasdaq 100 ETF or S&P 500 ESG ETF be considered as a core portfolio position? It can. I mean, look, for you to have a core position, you just need to have an ETF or an index fund of some kind. That's all you need, really, for it. You don't need much more than that. Bear me 1 second. Let me just get this. All right, so let me maybe draw this out for you. I don't know if this thing will work or not. Where are we going? Let's go here. There we go. So a core satellite approach, right, is essentially you have, let's just say 20K, right? And this in itself right here is invested in an ETF or an index fund of some kind. That's essentially a core satellite approach. That's a core. Then the satellite approach is when you have, you might have your Teslas, your Amazons, your Googles. Actually, it should be Alphabet. Sorry. You've got your Metas, Microsoft, all around the periphery of that core, right? So this is the bulk of your money here. Index funds, ETFs, these are your satellites, essentially. So you could have within this right here, your NASDAQ 100 ETF, your S&P 500 ETF. Yeah, that would be a core position. I think you're going to lack a little bit of diversification in there, though, because if you look at the S&P 500 specifically, it is a US index. So within the VUSA, sorry, I'm not writing this with the tablet flat down on the desk. So if my writing's a little bit nonsense, I apologize. So with the S&P 500, you're looking at a US exposed, let's get this right. You're looking at a US exposed fund, essentially. So you've got 100% exposure to the US, which for many people is poor diversification because you're missing UK, you're missing Europe, you're missing the Pacific, you're missing emerging markets, for example, you're missing other regions around the world. So it can be a core, but within your core, you still need to have a little bit of diversification. You need to, because otherwise you're putting all your eggs, well, proverbially in one basket, one geographical basket, although your sector diversified within the actual VUSA because you've got tech in there, financials, and all the other areas, but you're geographically in one place. And many will say that that isn't good diversification. Diversification is important. Hope that made sense. If it doesn't, let me know. Just trying to find where I am, guys. Bear me 1 second. All right, let's have a look at this one right here. Hi, Pete. What are you doing? What you're doing is greatly appreciated. Thank you, mate. What do you think the implications of rate increases by the Bank of England will be for the UK securities in the next 12 months? Look, the UK markets will pretty much behave the way the rest of the global markets behave, because the fundamental principles, it doesn't matter what market you're in, the reaction is still pretty much the same, right? So if interest rates are going to be going up, then the question is, if interest rates are going up and there's going to be a lot of volatility in the market, if you're not just in terms of, well, you're not okay with the level of risk that you're basically taking, and you know you need your money within a short period of time, the question of whether you're taking and you're willing to take that amount of risk for the potential return really becomes a conversation. Um, Obviously, we're slightly ahead when it comes to things like, COVID and all that kind of stuff. So I guess we're in a better position than some countries, but I still think that you're going to see quite a bit of volatility over the next 12 months, regardless of what happens with interest rates. Um, I think our central bank, the Bank of England, they waited for the states for the longest time to see what they were going to do, because they didn't want to be the first central bank in the world to move on interest rates. Got to the point where they had to. Now they've had to act very, very quickly with the numbers that came out, obviously, in the preceding 2 to 3 weeks, to move the bank rate again this last week. And this is the thing, right? So I'm going to go off on a little bit of a tangent here, but this is for good reason. And this is for anyone who has a mortgage. Now, I've spoken about longer term mortgages on the channel for a number of times. People think it's an absolute ridiculous idea to get locked into a 10 to 15 year mortgage. And sometimes I don't know whether people watch the entire video, because I try to give as much context as I can, or maybe I just don't do a good job, or didn't do a good job of trying to explain the context and the idea behind ultra long mortgages that are being brought to the market now. And this is what I'm going to say. You have to pay attention to the trend that's happening right now. So, first and foremost, we heard about this 3 months ago, right? Ultra long mortgages. Mortgages where you can fix in for 10, 15, 20 odd years. I covered it back end of last year. Then, literally within the last month or so, we've now had Habito with ultra long mortgages. Yeah. But now allowing 7 times your salary. Let's not get this twisted. It's only here in the UK that we don't lock in for long, like 2 years. 2 years, 5 years is what we would generally want to lock in for. The idea of an ultra long mortgage, 10, 15, 20 odd years, is not news. It's not brand new. The Americans do this all the time. And the benefit of it is you're locking in, protecting yourself against future interest rate rises. Now, in the UK, and I'm going to say this again, because in both of those videos where I talked about the long-term mortgages where people didn't kind of get the point, I tried to explain. If you look back to the 1970s, mortgage rates were 15%, 12%. That's what you were paying for your mortgage. So it would make sense at that point to lock in for 2 to 3, 5 years on a mortgage, because the only place that the interest rates were going to go at that point were down. You were not going to see them go up and above that. I mean, there was no way that was going to happen. And at least the sentiment at the time was it will only go down. That's how we got into this culture of, well, locking for 2 years, 3 years, 4 years, 5 years, nothing longer. Because the chances were that you would probably find that your mortgage rate will go down if you lock in for a short period of time. We have been in a low interest rate environment now for the best part of 10 years plus. The tide is changing. This is the end of cheap money. I'll say that again. This is the end of cheap money. You're not going to be able to borrow at these levels or historic levels like 2-3 years ago. You could get a mortgage really, really cheap, 1.5%, 1.2%. Those days are going to be over soon. The only place that these interest rates are going is up, particularly if the government does not get a hold on inflation. And with interest rates going up, it means that if you're not locked into a fixed rate mortgage right now, you want a standard variable rate, you've had a party for a very long time. The party is coming to a close. And one thing you don't want to do is to be left in the party when literally the music has already stopped. This is the slowing of the music, so to speak. You don't want to be in the party when the music is completely stopped and you still think there's something going on. There isn't. So if you are in a standard variable rate mortgage, you're going to be better off looking at a fixed rate mortgage now, because if we continue to see interest rate rises through this year and through next year, which Bank of England is already signposting, you will find that your mortgage payments are going to skyrocket. You combine that with gas, electric, internet services, right? Just the general squeeze on the cost of living. All of a sudden, life is going to get a lot more expensive for a lot of people. So if you're not fixed in already, go and speak to a mortgage professional and try and get locked into a fixed rate, because you don't want to be left holding the bag on a standard variable rate because you think, they're not going to increase rates. Rates are going up. The party is over when it comes to cheap money. And I have to say that because it's really, really important for people to understand. And when we talk about long-term fixed rate mortgages, if you're 20 odd, you're buying your first home and you have the opportunity to lock into a 10 to 15 year fixed rate mortgage. I know that it sounds like a very, very long time, but when you are speaking to your mortgage professional, you should be asking them very pointed questions as to whether or not that is a viable option for you to have a look at, particularly if the likes of Habito are not going to apply any early repayment charges for you to move and switch your mortgage. It's something that you should definitely start to consider. And I think that we're going to see more of these long-term mortgage products being introduced into the market. Again, you've got to follow the trend and you've got to listen to what these banks are doing. Nobody is going to launch a product that they feel is not going to be fit for commercial purposes. And you've also got to remember as well that these guys are building products and bringing products to the market based on what they think is going to happen in the future. So the question is, and this is rhetorical, of course, if the banks are introducing 10-year, 15-year, 20-year fixed rate mortgages, what do you think they think is going to happen to interest rates in the long run? You answer that question on a rhetorical basis, then you make your decision from there. That does not mean that you then all just go, right, okay, I'm going to go 20-year fixed. No, you've got to weigh up on your own merits, but it's definitely worthwhile listening and trying to get a wind or an understanding of what the trend is out there. These kind of products don't come to the market by mistake. It's very, very intentional. Right, where were we? There's a conversation back and forth around housing market there, so I'm just going to skip those. Sagar, thank you for this, mate. Appreciate it. Thanks for watching as well, mate. Yeah, come along to these every Sunday if you have questions. If you have questions tonight, just let me know. All right, this is a follow-on question here. Should I continue investing in ISA Vanguard US Equity Index? I feel it might be worth holding off until more certainty in the market. I have 40K so far and started investing a year ago. I mean, look, I can't tell you that you should or should not continue to invest in said equity fund. The question is, are you comfortable in being invested in that fund? If that fund, so for example, we get some really, really bad economic news tomorrow and that fund falls 5%, are you going to be okay with it? If the answer to it is yes, then great. If you then want to take that a little bit further and you say, okay, what if it goes 10%, 15%, worst case scenarios, would you still be okay with it? If the answer is no, then maybe you need to reassess. And this is what I talk about when I talk about risk. So number one, And again, I'm going to sound like a broken record, but it's very, very true. When I was advising clients, and for any financial advisor that you go and employ and pay good money to, will go through this with you. What are you investing for? How long do you have to invest for that one thing? So if it is within the short term, what's the worst thing that could happen right now? We could see a market correction. So if you're investing for 3 to 5 years and the market crashes, and it might take 5 years, 7 years for the market to recover, the obvious question becomes, can you afford to wait 5 to 7 years for the market to recover? Can your goal wait? Can you wait? If the answer to that is yes, then great. You basically crack on, but you still try to invest in a risk appropriate manner. If the answer to that is no, then that's a completely different kettle of fish. That's a different ball game altogether. So I guess the question back to you is, do you feel comfortable being invested in that fund right now? Bearing in mind that there is a lot of volatility at the moment and likely going to be a lot of speculation and a lot of news in the coming weeks about the markets. You're probably going to be turning on the news and watching YouTube channels and videos that are going to tell you that this is the end. It's really, really bad. Does that stuff influence the way you think about your investment? If you're investing for 20 odd years, then technically speaking, a market crash right now is a little bit of a bleep. It's a blip, sorry. It's inconsequential. It doesn't really matter. But without knowing your personal circumstances, it's hard for me to say, yeah, crack on, continue investing in this, because I don't know enough about you. I don't know enough about your personal circumstances, emergency fund, or anything like that to be able to give you a definitive answer. But those will be questions that I'll be asking myself, or at least be getting a client of mine that I was either coaching or when I was advising, taking on their investment proposition and building something for them. Those are the questions I'll be asking them to think about. ARC question. Trading 212 ISA account has an ARC ETP now. Okay. How does this compare to the eToro ARC K? Is one a better investment? I don't know, mate. I've not looked at the ARC ETP. It's an exchange traded product. So it will be a derivative of the main ARC K in eToro. But without having a good look at it, I wouldn't be able to tell you, mate. I My initial reaction is that the one in trading 212 it won't be Kathy's fund. It will be a derivative, so derived from Kathy's fund. So it might be a copy of her fund, but it won't be the exact thing. How do bonds usually behave in high inflation and interest rate environment? Really, really good question on this one. So, I mean, look, the main function of bonds really is to basically have it to be a counterweight to things like equities and stuff. So, the best way to kind of put this across, and I'll see if I can actually just draw this out as well. Actually, to be fair. And also, it depends on what kind of bonds you're actually going for as well, because within bonds, there are different kinds of bonds, but the premise should be pretty much exactly the same all the way through. Now, technically speaking, if you have like, let me just get this on actually, 1 second. So the idea of, bonds and equities have always been that you would always have a counterbalance to your position. So the way it always explained to me was, if you have like a seesaw right here, and let's just say you have equities on. No, I don't want that. And let's just say you had. What are we doing? 1 sec. Go there. There we go. Okay. So let's just say we had equities on this side, and then you had bonds. Actually, I'm going to use a different color for this. I'm going to use bonds here. Yeah. The idea is that when you have a look at how markets tend to typically behave, you'd always have a counterbalance here. So when equities went up, you might have bonds go down a little bit here, but equally when bonds go down, sorry, when bonds go up, you might have equities go down, because ultimately, when you're looking at an investment construction, so you're trying to build a portfolio specifically, you're going to get most of your growth from your equities, and within your bonds, depending on how you access them, they will have things like coupons attached to them. So you have an element of knowing what kind of return you're going to get from this element here. So it's like a diversifier. And when you think about high inflation and you've got interest rates, and this kind of leads on to the conversation we had a little bit earlier on, right? So the default way for you to uh, counteract the impact of high inflation prior was to have a look at a high yield savings account. That would be the easiest way for you to do it. And a high yield savings account would be like an account in your bank, building society, for example. You literally just put some money in there. You can offset the impact of inflation. So if inflation was running at, say, I don't know, 3%, but you could go and get a savings account for 5%, then it would make sense to put money into an actual bank account than you would do go and invest it in, say, the stock market or into a bond, for example, because it's the equation of risk versus reward. Now, when you're looking at bonds specifically, you're looking at high interest rates and high inflation. Well, the way the bonds basically behave, they have like an inverse correlation between interest rates and bonds. But fundamentally, the question will be, can you get a better return here than if you went here in any scenario? With interest rates, with interest yields going up, then what you should see, and I need to make sure I get this the right way around, because it's inverse and it can be very, very confusing, is you either see that if the interest rates go up, these yields will go down, which makes that a little bit less attractive within the investment portfolio. So a lot of people will have a look at bonds as being one of the main drivers in an investment portfolio in terms of returns. Typically speaking, historically, it is always going to be your equities that over the long term will outperform bonds in every way, shape, or form in an investment proposition. And again, if you're using the likes of Vanguard and you're using, their index funds and their ETFs, you probably won't have any bond exposure at all, because most people will go for the VWRL, which is global, but it's 100% equity. So you're getting zero exposure to your bonds over here, because unless you include them yourself. But even within the bond section, when you're on Vanguard, for example, you have to pay attention to the kind of bonds they actually have available. So, for example, within the bond element, you have corporate bonds and you have government bonds, right? Then within all of this as well, you then have, investment grade, and then you have junk bonds as well. Well, I say across this right here. Let me just scrub that bit out, because that's not technically right. One sec. Let's get this right for you guys. Okay. So within your corporate bonds, you then have investment grade and you have junk bonds as well. So investment grade bonds will be companies like Apple. There'll be companies like Microsoft. There'll be companies like Alphabet. There'll be companies like Meta or Facebook. So these will all be companies that are massive. They make a lot of money, a lot of cash in the bank. They have a really, really strong credit rating as a business. These are investment grade bonds. So the idea is, with a bond, obviously you're taking out a bond, you're lending one of these companies money. It's an IOU. In exchange for that money, they're going to give you a certain return every single month. So let's just say for these guys, they might say, the coupon on this will be 3%, for example, right? You're going to get that, but it's relatively low risk because they are an investment grade bond. So they've got a really good credit rating. That's very, very different for a company that might be a junk bond, who doesn't have the financial strength of these companies right here. They don't have a strong credit rating per se. So there will be a little bit more risk in this department, but in exchange for a better return, for the additional risk that you're taking, you might see a 5% return as opposed to a 3% return here. And if we go into Vanguard, actually, let me just show you, because if you have a look at the life strategy funds, this is the one thing that I do like about Vanguard, is they already have some of those, because life strategies are fund to funds, aren't they? They already have built into them. Where are we going? Vanguard. The bond funds. and you get to see whether they are corporate bonds or gilts. They don't show you specifically whether they are investment grade, but them being Vanguard, they will all be investment grade. So let's just go, for example, into. I'm gonna have to share this screen with you guys. Bear me one second. Let me just set this up and pull this out so that you can see this properly. Okay, I need to add. There we go. Okay, so if we went onto the life strategy fund, by the way, so this is on Vanguard, right? And let's just choose for one moment. Let me just get this a little bit bigger for you. The 80-20, all right? So this has got 80% equity, 20% in bonds here. If you go on to the portfolio data, you're going to see here, now where are they? So you got UK government bond. So this is a gilt. This is a government bond essentially. So less risk of default. The UK government always pays back its debt. You've also got inflation-linked gilt here as well, which basically means that with this one, it's inflation-linked. Then you've also got UK investment-grade bonds in this one as well. Now, if you wanted to, we could go and find each of these so we can see what the makeup of these are. But what I'm trying to say here is you've got pretty much majority of this invested in equity. So FTSE 100, FTSE 250. You've got the Japanese stock index in here. You've got FTSE developed Europe, excluding the UK, emerging markets. You've got developed world here. You've got US equity. You've got the FTSE All Share. You've got another bond index here. This is a global bond index here, right? But you've got a smattering of bonds in here to help you, and they will all be, well, the ones that are corporate, they're all investment grade bonds essentially, aside from the ones that are government, because within governments, they will only literally go and source countries that have a very, very strong track record and credit score themselves. So UK government, US bonds, they are always satisfied, and the governments wouldn't want to not pay their agreed coupon, because it would just be bad news for the future if they wanted to raise money. So a bit of a long-winded answer, but I think if you're going to be using bonds as part of it, you need to understand what role is that bond going to play within the portfolio. Is it there to give you a bit of stability, to act as a diversifier? Because you could get okay returns within a bond, but it's not going to be the engine of your growth. Bonds really do work well, and they can work well if you're investing with a particular target. You want to do, I don't know, 5% per year or 7% per year. If you've got X amount coming from a bond, then that could serve a really good purpose. If you're looking at, I don't know, planning for retirement, you need an income, for example, you could also use it there. But then you could also argue that dividend stocks will be really, really good, and they are very, very good for income as well. Yeah, appreciate that, Matty. Yeah, my symptoms are very, very light, mate. And I'm a little surprised. I think the being double vaxxed has helped massively. Um, but yeah, I had a headache on like Monday. I couldn't sleep. I didn't sleep all night, and I just thought it was just a normal headache. Then on the Tuesday, I had the tickly throat. Once I felt that, I went and bought like 3 packs of soothers and swallowed those after a few hours. And then on the Wednesday, started to cough. Thursday, it kind of died down a little bit. So my symptoms have been very, very, very mild, thankfully. But yeah, cheers, mate. Edna, I'm good. How are you? What do I think of AMC? AMC is a stock. I've not actually had a look at it as a stock, but I do know that they are a chain of cinemas. A lot of the cinema stocks took a little bit of they did suffer during COVID. I mean, at the very, very beginning of the pandemic, there were certain YouTubers making videos about, buying AMC and cinema stocks. And for the life of me, I could not understand why that would even be something that you would consider at the time, because it was like, we're at the beginning of the pandemic. We know that globally everything's shut down. We don't know how long they're going to be shut down for. People were buying it at a discount thinking that was going to be the floor. And I remember watching a few videos, and it's like, I think there was a lot of enthusiasm around them at that point in time. So some of them did actually return quite well within a very short period of time, which would have been great if you kind of like day traded it or did a short trading period for it. But then you saw a lot of them then suffer as the pandemic got protracted, and obviously then studios completely halted on productions, and we're still not back to full strength really when it comes to movie releases. We're slowly getting there. um but yeah, I mean, if you're going to buy it, the question is going to be, what was the pandemic like for them? Did they take a massive hit? Have they got cash reserves? Those are the things that I'll be looking at. I'll be looking at any of their quarterly returns, any commentary from the leaders of the business around what their plans are coming for after COVID, their forecasts. What are their plans specifically? That's what I'll be looking at. You probably might be able to pick up one or two of them at a really, really good price if they've fallen in value, but it is your decision has to be made surely on what the future viability of the chain is. That would be my initial thought, but I haven't had a look at AMC as a stock specifically. And this is where, obviously, if you're picking your individual stocks, you need to do your homework. Like, you really, really need to do your homework, and you need to understand what the numbers are saying about that specific chain. Because yeah, COVID was not kind to a lot of these cinema chains. It was really, really brutal for a lot of them. But let's have a look. What I thought IBKR. I haven't looked at them, mate, if I'm completely honest. So I couldn't tell you, Jeff. Um, I couldn't tell you because I haven't looked at their service. I'm sure if they've got an ISA, I don't know. I don't know about their cost, but I'm sure if they've got an ISA and they're putting a product out there, they would have had it well researched and packaged and stuff. But I couldn't tell you. I don't have an opinion because I've not really looked at them. All right, bear me 1 second. Let me just get to. Can I highlight one where I am right now? Bear me 1 second. Can I highlight this? I don't know if I can highlight this or not. Okay, I might have to come back to this. I just want to get to Jeff's question. Jeffrey. Thank you for the super chat, by the way. I'm just going to come to you really quickly. Thank you for this, Jeffrey. It really does help support the channel. Okay, so hi Pete. Do you ever look into invest? Do you ever look to invest slash trade when you see potential short or long opportunities, i.e., Facebook right now? What's your advice on this? I don't personally look to long or short any specific stock. Number one, I don't have the time to be looking at it, mate. If I'm completely honest, I'm too busy during the day, and for me, if you're going to long and short it, you kind of need to know what parameters you're working to. It's not just a case of I'm going to short this stock right now. You do need research into, okay, right. So if I'm going to short it, for example, what's your target on the way down? So if it's, I'm just going to make the numbers up. If it's $200 right now, what are you shorting it to? Are you shorting it to 180 to 150? You need to have an idea of what that parameter is. The same thing's on the upside as well, mate. If it is 200 now, you believe it's going to go back up, but go back up to where? Where's your margin? You need the research and the know-how to be able to do that kind of stuff. I mean, who have I bought recently? I did buy recently. Who did I buy recently? I did this over the last couple of days. I'll remember it in a moment. But I bought stock a couple of days ago because there was a little bit of news, and I just thought, okay, this might be a really, really good hold for the next 3 to 4 months. Put a little bit of cash into it. I think I put 1,000 or so into it, and see what basically happens based on a little bit of news and based on kind of market trends that I'd seen before when similar things had happened. And I'm reluctant to say this now because I don't want people to be like, oh, Pete's just gone and done this, so I'm going to go buy this. There's a little bit of thought that's gone through it. What I'm trying to say here is, if you're going to long and short something, you need research. Your decision has to be based on research. If you're going to short it, where do you think it's going to go down? If you're going to long it on the way up, how far up do you think it's going to go? That is the main question, really, to make sure that you're okay on. Number one, where you're going to get your research from, how are you going to do the research if you're going to do it yourself, and then the execution of it. Who are you going to use to execute it? For goodness sake, please don't leverage. Please don't leverage, because that could get you into trouble. But I mean, I'm not going to say don't do it, but just try and understand what it is that you're going to be doing, because that's really important. Let me just deal with something for a second, guys. Right, hang on a second. How do I do this? 1 second. And let me just see if I can. Bear with me a sec. I might have to do this another way around. You guys will probably notice that my comment section is very clean. I don't have like any I guess hack comments or bot comments or anything like that. So when I do a live like this, and this has only happened a couple of times, and I see, there's this hack bot or whatever, I'm not going to have that kind of stuff here in the chat. So what I'm going to do is I'm going to just get rid of this person right now, because we're not going to have any of that here. Okay, right. So let's just see where I was. Where was I? Okay, I think I found it. Where am I? Was it here? Okay, there we go. That was the AMC question. Oh, cheers for this, guys. A couple of you did find benefit in the mortgage perspective that I gave here. It's really important. Please don't sleep on this. Really don't sleep on this, because we know that the interest rates are going to go up. And yeah, your mortgage is often going to be your biggest monthly expenditure, particularly if you want to make sure that you've got enough money to put into the markets with everything being down and the possible volatility that we're seeing. Part of the prudent approach is having some money set aside so that you can throw into the market. Sorry. So whilst everything is going up, if you're able to fix a mortgage, save a little bit of money on a mortgage, maybe that will give you money that you could then potentially invest into the market. So I'm glad that a couple of you found that the mortgage conversation really useful. Thinking of starting to invest for the first time, have done loads of research and still can't pick which one is safer, Vanguard or Free Trade. See, whenever you invest, your capital is at risk, first and foremost. So there is no such thing as a safe investor. When you're using safer with regards to a provider, where my head automatically goes to is financial strength, because that's the only thing that you can have a look at to gauge whether a company is safer than the other. The actual act of investing is risky regardless of who you use. But let's just dissect the difference between Vanguard and Free Trade. So Vanguard will not allow you to buy individual stocks. So you can't go and buy Amazon or Tesla or Microsoft as an individual stock. You can do that with Free Trade. Vanguard will give you access to ETFs, index funds primarily. It will be their own index funds and ETFs that have been built and researched by them specifically. With Free Trade, you'll be able to access ETFs and index funds, not just from Vanguard, but from a whole host of other people as well. But with Vanguard, you're going to have to pay a little bit extra. So things like your ISAs, for example, you've got to pay £3 a month for your ISA account, which is £36 a year, which isn't a lot of money. But a lot of people will be like, oh, I don't want to pay that £3 a month because I could do something else with it. And particularly with increased cost of living now, £3 can go a long way once you add it all up. So you're going to pay a little bit more with Free Trade, but you're also going to be able to do a little bit more with Free Trade. Now, being able to do more isn't necessarily a good thing if this is your first time doing anything. So my question back to you, and again, this is rhetorical, of course, How have you landed on Vanguard and free trade? Have you landed on Vanguard and free trade because you're being told that that's the cheapest way for you to invest? Rhetorical question. The better question to ask yourself is this: how do you want to invest into the market? You're only just starting out. This is your first time. If you go into Vanguard and you looked at their funds, would you know what it all meant? If you read the objective for a fund, do you know what that means? If you look at the portfolio data, do you know what all of that means? If it doesn't, then I would strongly question whether Vanguard is actually the right platform for you to use. The same thing applies with free trade. If you're looking to use free trade and your goal is, I want to pick those individual stocks, because, and by the way, guys, stock tips are a dime a dozen. You could pick up 1,000 different stock tips just by watching YouTube videos. Doesn't mean that they're all good though. I mean, look at Peloton. Look at Peloton. Didn't they cut something like 42% of their marketing department recently? And there are channels here on YouTube that are telling you, and have been telling you for the last 12 months, this is the stock that you need to have. So if you're paying attention to that kind of nonsense, Peloton would have been a really, really, really harsh surprise for you recently, because you would have been like, wow. Because you wouldn't have seen this coming, because all the videos you've watched have told you Peloton's the one. They're changing the game. So stock picks are a dime a dozen. If you don't know, if you can't go into free trade, go into Vanguard, and understand the literature that you're reading, you shouldn't be using either of them. What you're probably better off doing is using a provider that will do all of it for you, that will help you, that will select all of the investments for you and manage it on your behalf. If you know nothing, that's the route you should 100% go down. Because doing Vanguard or free trade, just because you've been told they're cheapest and it's easiest to use, maybe easy to use in terms of interface, but easy to understand and actually monitor and manage your investment because it's your responsibility. No, it's not. So if you're a first-time investor, ask yourself, how do you want to invest? Do you want to do it all yourself? If that is the case, fantastic. But do you understand what you're doing? If the answer to that is yes, fantastic. If the answer to that is no, then you need to find another way. And the other way would be to actually pay someone to do it on your behalf. There are lots of apps that will help you do that. Wealthify, Money Farm, or a few that I've spoken about here. Go to those guys. They will do it on your behalf. You don't have to worry about management, monitoring it, reviewing it, the whole thing. The downside is you're going to have to pay them a fee to do it. That is the downside. But ultimately, do you want to be responsible for either making or losing money on your own, knowing you're not going to really understand any of the market news that you might be hearing? You know, if I said to you, how does the risk of an interest rate hike impact the volatility in the market? If you don't know that off the bat without having to do further research, that's going to cost you time. And in that time, the market could have moved and you haven't made any moves or taken action, then you really should be paying someone to do this for you. And this isn't a popular opinion. I know that it's not. Too many people on YouTube are saying, yeah, low cost, low cost, low cost. Low cost is great, and passive investing is great, which is low cost, when the markets are continually going up. The markets are no longer continually going up. Therefore, there is a strong, strong, strong argument for active management now, or at least employing someone who's going to do that for you. So please don't just be careful the stuff that you're coming across here on YouTube. I try to be as honest as possible. I don't mean to burst anybody's bubble, but I'm trying to tell people the truth based on my qualifications, based on my experience, based on the fact that I've worked with people who have been through a market crash, and the market crash has significantly impacted their goals. And in honesty, some of it could have been avoided, but it wasn't. So it may not be a palatable or popular opinion, but that is an honest answer for you. Richard, I'm 37, planning to retire at 55, okay, 18 years. I have a couple of pensions and a stocks and shares ISA, all recently 100% equity and high risk. At what age should I start transferring equity into bonds? Mate, well, I can't give you a definitive answer on this, but I can tell you from an investment management point of view what the timeline for what you would call. So, what you're trying to describe there is lifestyling. Okay. So, I will draw this out for you just so that you can get a visual representation of this. One sec. So, I just need to reselect that other screen. 1 second, guys. Okay. So, what I'm going to explain here is something called lifestyling. And I might go down a bit of a technical rabbit hole here. And forgive me if I get a little bit too far ahead of myself, but this is a really important conversation. So, lifestyling is essentially the idea that if you have right now 100% equity, as you're describing here, yeah, and let's just say in the future, you have your retirement date right here. What lifestyling basically suggests is as you get closer to this date here, so as you start moving towards this date right here, at one point you're going to inject a timeline, an event right here. And at this point, what will happen is you will start to taper out from your equities into lower risk assets, things like bonds, right? So we explained bonds a little bit earlier on. And it might mean at this point, because let's just say you are 5 years to your retirement date, you might have had 100K invested at this point, and I'm just going to, again, make up these numbers. You might have had 100K invested day one, and at this point, it might be 200, yeah? So what you don't want is in the last 5 years to your retirement journey, you don't want the market to come down here so that when you get to this year right here, your money is now worth 180. You want to try and protect as much as you can of what you've grown. So when you get to this juncture here, this juncture right here, you start to lifestyle. So you might say, okay, I'm going to go down from 100% equity here, and at this point, I'm going to go 60%. Then every single year past this, you start to reduce the amount of equity you have. So you're going from 60% equity to 40% equity to 20% equity to 10% until you're pretty much all just cashed in to protect whatever the value is. And let's just say the value at that point is now 230K. That's lifestyling. It's tapering out of equities into bonds. Now, people used to do this all the time. This was the norm for the investment industry to do. That was true up until when pension freedoms was introduced. And I think it was back in 2014. Because back then, what would happen is the amount that you amass right here, you would go and exchange that for an annuity. An annuity would say, right, you've got 230K, okay? And Richard, if you give me your 230K, I'm a business, by the way. If you give me your 230K, I will give you 15K per year, per annum, guaranteed until you die. And those were based on annuity rates at the time. The problem is, since interest rates started to fall, annuity rates became a bad deal. So pension freedoms was actually introduced to say that actually you no longer have to worry about buying an annuity when you get to your retirement date. For you, it's 55. You can just hold on to your cash and invest it in whatever way you want to get the best level of income for you in the future. So for you, what you're asking here is, how do you potentially protect yourself in this fashion, and when do you start? Now, you've got, 18, what's that, 13, you've got 18 years into your retirement date, essentially. So you've got 18 years between now and 55. Let me just do this right with the ages, actually. Just get it right. 37 right now. Okay, so that right there is an 18-year time horizon. Yeah, 18 years. Now, look, I can't advise you, and this is what you should be doing. But again, these are things for you to start thinking about. First and foremost, how much do you need here at retirement? What's your income amount? Is it 10K? Is it 15K? What do you actually need? And are you on track for that? That's the big thing. Obviously, your state pension won't be available here, so you're not going to have that here, but you can have access to your tax-free cash. Are you going to take that? What are you going to do with it? How big is your pot? I don't know any of these factors, right? But the real question is, how much do you need in retirement? Do you know what that amount is? If you're close to that amount, then that will change a little bit how you view this. Because if you know you've got more than enough to cover your income, then the question will be, well, actually, the answer could be you could start to taper anytime you want if you know you're going to hit your target. So let's just say when you retire, 55, you need 15K per year, and you know that you've got enough money in your pension pot to supply you 15K per year. You could literally de-risk yourself at whatever point makes you feel most comfortable. If, however, you do know that actually I don't have enough in my pension pot to be able to give me 15K per year, then really you need to remain invested for as long as possible to get to this target. So if you're 100% equity at this point in time and you haven't got, the 15K that you need when you get to here, then technically speaking, you need to be invested as close as possible to 55 without overextending your risk. That is really, really tricky. And that's where I'd say you need to see a professional, a financial advisor who can cash flow forecast for you so that you can really get a real good handle over the actual numbers. So if they plug in certain assumptions, if the market does this, if the market does that, this is what you're going to be looking at. This is the potential outcome. It's planning, not just putting a finger in the air and thinking, we'll see what happens. This is methodically and scientifically, numerically worked out. If over the next 18 years the market does this, this is what your outcome is going to be. If we want to invest based on you need this and you need this amount of return to be achieved over the next 18 years, this is how we would invest it. This is what we think this portfolio is going to produce. That's the benefit of a financial advisor. And to be honest, mate, without knowing much about it, you would benefit greatly from having that kind of cash flow modeling built in with 3 scenarios at least mapped out for you. So you knew, regardless of what happens over the next 18 years, market crash or not, you're going to end up in X position, or you will have the best chance of ending up in X position in the future. It really depends on whether you know number one, whether you know what your retirement amount is going to be, first and foremost, and whether you have enough in your pension pot right now to be able to meet that amount. Are you on track for it? If you are, then your approach will be very, very different in terms of when you decide to taper out of equities into more secure assets like bonds and, I don't know, commodities, for example. Whereas if you are nowhere near, then you're going to have to take more risk and get invested in higher risk propositions or asset classes and a portfolio to try and get you as close to your target as possible. It's not a straightforward answer, Richard, because there's a lot that goes into the planning for that. But if you don't have a financial advisor already, and look, these guys don't they don't charge you anything to sit down and have a consultation with you. I would strongly suggest that especially if you know that you've got a long way to go and you may not meet the amount of income that you require, you should see a financial advisor. Of course, you can try and manage it yourself, but you kind of need to have an idea of what income you actually will need in 15 years time, 18 years time, when you actually are set to retire. What does that actually look like? Your state pension won't kick in for a good number of years past that. Probably 12, 13 years after you've retired at 55. Are you going to continue working? Where's that income stream going to come from? Those things need to be put into a picture, and a plan needs to be derived off those, I guess, potential hurdles or springboards, really. So it's not a direct answer. It really depends on your circumstances. But hopefully, what I just illustrated there kind of gives you a bit of a better picture of maybe some things to actually think about. And yeah, that bottom bit, Let me just get this back up again. Sorry, 1 second. This right here is a really big factor in the conversation. All right. Okay. Right. Let me just scroll down quickly. Okay. We're going to try and get to as many of these as possible. Hi Pete, why are you not in the buy-to-let business? The buy-to-let property offers the best returns overall. Few publishers believe Telegraph Brewing. Because at the end of the day, I have no interest in the buy-to-let. Buy-to-let market doesn't do anything for my goals at this point in time. If it aligned with my goals, then I probably would, but it does not apply to my goals. It's not going to help me achieve my goals at this point in time. For my short to medium term goals, I need liquid money, and I'm not going to be able to have liquidity in my approach if I go into buy to lets, unfortunately. And that's just the reality of it all. I mean, I've got money lying around at the moment where I could probably put money into a few buy to lets, but it's not going to serve the purposes of my short to medium term goals. So I'm not willing to lock up money into property, into buy to let properties. The yields aren't going to help me achieve what I want to achieve in the short to mid term. And that's the reason why I'm not into buy to lets myself. I think with the property side of things, it's very very similar to the stock market. People get carried away with what's happened. Oh, 1 second, I need to change this battery. With the historical numbers around the markets, which is fine. Everybody does that. But the property market is not infallible. The property market can still had a crash. It still had a crash back in the major recession. Are we going to have a crash right now? Probably. Who knows? We don't know. I have no idea. The equation that everyone still talks about, which is true, is the fact that people still need to live in houses. That is very, very true. But the market in which you buy these things also becomes very, very important as well. And for me, the one thing that I don't necessarily see much benefit in property is there are not a lot of tax efficient vehicles within property that you can exploit, unlike in the stock market with stocks and shares. And for those reasons, for me at this point in time at least, property isn't something that I'm necessarily interested in. It might be in maybe 5 years time, once my short to medium term goal is out of the way. Then I can have a look into properties properly. But for now, it just doesn't feature so much in my overall plans right now. But that's just me. That isn't to say that people shouldn't invest in properties. I know a lot of people who are invested in properties who do very, 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 very well and have really, really good portfolios. But it's also a lot of very, very hard work. It was okay. Love the videos. Quickie. If I open a stocks and shares ISA next week, do I only have until April the 5th this year to load up 20K, or can I add it over the years to come? Right. Okay. So for this current tax year, you have up until the 5th of April to put in your 20K. On the 6th of April, you're going to get a new 20K. So if you can, 20K or not, just put as much as you possibly can into the ISAs come April the 6th. But remember, April the 5th, sorry. But remember, the minute you get to April the 6th and the tax year resets, anything you haven't used in this current tax year, you're going to lose completely. So just try to make sure you utilize as much as you possibly can between now and April the 5th. Then on April the 6th, you're going to get a new £20,000 for the new tax year to put into an ISA. Yeah, Christian has basically just said exactly the same thing right there. Well done, Christian. Thank you. I'll tell you what, mate. You were very, very lucky if you managed not to get it. Yeah. I don't. You know what? The strangest thing is, I don't even know where I actually got it from. I don't know how I managed to get it. I mean, I was in London last week, but I was in London on the Friday night. not this last week gone, the week before. I was in London on a Friday night. I had a call on a Saturday, and literally I got down there really, really late at 10:30. I checked in, went upstairs, slept. I had a meeting in the morning. I had my meeting in the morning, checked out, and left. So between it, I must have caught it at that point, and I have no idea when. I wore masks and all sorts of stuff. It's very, very strange. I mean, for 2 years, being careful and not catching it to then catch it in this past week. It's one of those ones. Oh, thanks, Edna. I appreciate that. All right, this is a good one. Any advice if you are going to reach lifetime pension allowance? Continue to pay into a pension or stop to avoid super tax? Really good question, Lee. If you have you The question is, have you got protection? Because you can get protection on the lifetime allowance. So have you applied for protection? Um, if you haven't, that could really, really help you. Um, how old are you? I don't know the answer to that question, but sometimes you can take tax-free cash. That will help you reduce it a little bit. Um, but you've got to be 55 in order to be able to do that. Again, this is a prime scenario where seeing a financial advisor would really, really help you, because what they will do is they can actually run some calculations and present you with some viable options based on your circumstances specifically, but also take into consideration that at some point you're going to retire. Now, if you're approaching lifetime assets or you've reached your lifetime allowance, get my words out, then you have got a mega, 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 mega pension pot, which means that hopefully, income wise, you're going to be absolutely sweet. But you should take advice, mate, because sometimes it is worthwhile taking a hit on the tax, but it depends on your circumstances. But yeah, tax free cash you can take. I don't know whether you've applied for protection. Sometimes you can apply for protection as well, depending on what lifetime allowance level you're at. If you apply for protection, that can also help you. So it will pretty much get rid of the tax scenario in the first place. But you, sir, should definitely seek some advice and sit down with someone who can present you with the actual options, run the numbers for you, so you know exactly what the scenario is in front of you. Thanks, Aura. That was what I was talking about right there when I was trying to basically get rid of them. I just, obviously, I've only had this maybe one or twice before on a live chat. I don't know whether they're still here or not, but I put them in timeout in the end. But yeah, it's like I don't understand whether they actually feel as though. I mean, people must fall for it, obviously, because otherwise they wouldn't do this kind of stuff, right? But it just makes you think that it may be a bot, maybe it's a person. If it's a person, it's a really nonsense job to have. But there you go. Adam, you know what? I like this. So I'm so glad I made the decision to get rid of my debts and try to overpay my mortgage starting at the last Durntown. Not only have 12-month mortgage left in a mortgage of age 44, mate. Look, this is what I mean when I answered that first question. What's going to make you rest at night better? Like, no, being mortgage free at 44 in 12 months time, that's pretty awesome. I mean, let's just back out of this a little bit, right? So with all of the news of the cost of living increasing, you're going to look at this very, very differently, mate. The way you're looking at it is, well, actually, I'm going to be sweet because in 12 months time, my biggest monthly expenditure, the roof over my head, is going to be completely paid off. For you, mate, cost of living, you're going to look at it a completely different way because your financial landscape is going to be very, very different now. And actually, that's probably the definition for many people of freedom. You can now choose what job you go to. If you want to continue in a job that maybe you haven't really enjoyed, but it's been a means to an end, i.e., paying off the mortgage like this, gives you options. You've got to do what you feel is right for you. Yes, you could have made a lot of money in the markets over the last 12 months. It would have been bumpy, but actually, if you were to contrast those two situations, right? You invested money into the markets and maybe you've made a few £1,000s over the last 12 months. Would that make you feel better than you're feeling right now, knowing that your mortgage is going to be paid off in 12 months' time at 44? I would hazard a guess, probably not. And I think that's what people need to remember. Like, it's sexy to invest in the market. It really, really is. Don't get me wrong. And everyone should be excited about that. You can create wealth. But when it comes to something like this, like, you're gonna sleep so much better. And I would argue that maybe after your mortgage actually paid off, not only is your quality of life and just your general sense of well-being going to improve, you'll probably go on to something that you enjoy a little bit more. And if you wanted to, you could use that as a springboard to earn even more money. It's a you have to do what you feel is right for you. And it's amazing the the headspace you get into when you get to the point where you're making decisions purely with the goal of, okay, I want to try and get as much balance and equilibrium out of a situation as possible. It's really, 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 really life changing. I mean, for me, my short to medium term, everything that I'm doing here, obviously for the long term, is to try and educate people, so on and so forth. But it's helping me towards my short to medium term, which is essentially being able to have a different way of life in a completely different climate that feels different and will feel very, very different, because at that point we'll hopefully be in a position where things like mortgages aren't going to be a massive burden. I'm very, very lucky. I have very, very little debt. I have a mortgage. That's it. I don't have car debt, personal finance, no credit cards. I've got no debt whatsoever. And for me, that's been a massive, massive kind of like weight off my shoulders after spending years and years and years in my 20s carrying debt and being depressed from debt and ignoring my finances because I was in debt. I know what that's like. So to be in a position where I don't have any consumer debt, I've got my mortgage and I could pay off a ton off my mortgage, but it means, well, actually it's going to take away from my short to medium term goals. It's balance. What makes you feel like you're going to sleep better at night? I know that I sleep better at night thinking about where we want to be in 18 to 24 months' time, and potentially what shift that is going to mean for us, and the fact that we're going to have options at that point in well as well, which will mean that I can make different choices from a work point of view as well. This is a beautiful comment, mate. Thank you. Oh, JS, cheers, mate. I appreciate you for this. Thank you very, very much. Thank you very, very much. Where do you get penny stocks in the UK? I mean, Jess, penny stocks is not what I don't talk about penny stocks here on the channel. Penny stocks can be great, but penny stocks are penny stocks for a reason. I mean, the technical term, what the technical definition of a penny stock is any stock that is trading for less than $5 or £5. There are lots of them that you can go pick up, but I don't typically focus on those kind of companies because they do present, in a lot of cases, an extra bit of a risk that a lot of first-time investors aren't necessarily open towards. And if you're looking at buying individual stocks and the price is what you're using um, as your primary gauge as to whether you should invest, it's the wrong place to start. So I don't generally speak about penny stocks here on the channel, just because they just generally represent a higher level of risk. Right, just looking at the comments, there's quite a few here that I've not been able to get through, and we've been on for an hour and a half right now. I'm just going to scan some at the bottom here and see if I can pick some quick ones to answer. Appreciate you guys, though, for being here. Thank you. Okay, let's have a look at this one. Thanks for this YouTube channel. I'd like to know if it's better to buy or rent. What do you think? Okay, this is a really good question. Um, you know what? Every time I talk about this, I find that there are people in two camps, and I definitely get a sense that there is a big generational change of opinion when it comes to buying or renting, and this is the primary reason why I think that is so. I think we live in a society now where we realize, or at least Gen Zers and younger, are coming to the realization. I think this is maybe even applicable to some millennials as well, that work doesn't work anymore. In terms of, we spoke at the beginning of this session about this whole perfect storm, right? High inflation, um, wages aren't really keeping up with inflation. Then you've got increase in house prices. Generations are now coming to the realization that you can't go to work, earn 100 grand a year if you're in London, and still afford a comfortable place to live in a place like London. And that's at 100 grand a year. And by the way, if you're earning 60 grand plus, you're in the top quartile of earners in this country. So how do we live in a society where you have to be aspiring to be earning 150, 200,000 pounds for a place like London in order to be able to afford something that is comfortable to live in, where you don't have to flat share with people? There is a huge generation of people who are coming to that realization. And therefore, I think that the appeal of owning, or the reality of owning a property, the shine's come off it a little bit, because it just feels unattainable. Because number one, your wages aren't keeping up with inflation. They're certainly not keeping up with house prices. And then you need ridiculous deposits in order to be able to get a mortgage in the first place. My take on renting versus buying is that if you can, in some way, shape, or form, be disciplined enough, find a way to get a deposit for a property, you're better off owning than you are renting. Purely because at the end of the day, and this is the way the economy and economics work in general, call it capitalism, ownership matters. Ownership really, really matters. As a renter, somebody owns your property, which means that you're paying off that person's mortgage, which means that all the time that you're doing that, that person is benefiting not just from a rental yield, but benefiting from the increase in the property value whilst you've been living in that property. So essentially, you're lining the pockets of somebody else. And I think it's really, really important to be able to own that asset. So own your property. I fully appreciate, though, that for many people, they feel as though it's not something that is ever going to be reality for them because of the way, I guess, our society is set up. And that's a damn shame. I mean, if I look at my journey, if you watch my film, my parents are not wealthy. They sent me back here when I was 17. Like, I've been homeless a number of times. I don't have any family here that could have helped me out with a house deposit. I had friends who their parents would buy them cars and, give them money towards the deposit. I had friends that their parents would buy them flats. And it's like, I'm looking at them thinking that would be very, very nice. But knowing full well that I was never, ever, ever, ever going to be able to go to my parents and ask them to help me with a deposit for a property. That was never going to happen. And so for me, and again, I cover this in my story in my video, finding my way into a place like Canary Wharf, where it's like, hang on a second, there's a load of people who make a shed load of money here. That was really my opportunity to find myself in a position where I could earn as much money as possible to give me the ability to get that deposit, to get on the property ladder. And I took that opportunity with both hands, because that was a seminal moment for me where I knew this is going to be the one and only opportunity that I'm going to have that is going to put me in the position where I can potentially work really, really hard, earn good money so that I can acquire a deposit for my property. And that's what I did. But I know that for many people and the younger generation, that can feel almost like an impossibility now. With that being said though, and I want to say this in the right tone, I think the gift that the younger generation have now, the Gen Zers onwards, they have now, is social media. If someone said to me 5 years ago that I would have a business online on YouTube, based on YouTube, that would afford me to be able to do what I like, do what I enjoy, help people, and earn good money, I would have laughed them out of the room. The things that you can do now on social media with things like YouTube, I mean, it's not too late. It's never, ever, ever too late. The earning opportunities that you have are endless, are endless. I think it's just about trying to find where you can, I guess, use your skill, use your knowledge, use your talent per se to generate a presence of your own that you become known for, that you potentially can use as the catalyst for you to be the master of your own destiny. Um, but yeah, if you can buy. That's my opinion, because I think ultimately wealth is created in assets, and you need to be able to acquire assets to be able to create wealth. I mean, just look at all of the millionaires. Look at all of the guys who have done very, very well. They own something: property, business, stocks, shares. It's in ownership. You have to participate. All right, guys. Uh, okay. All right. Let me just take one more. Let me just take this one from Don. I'm going to take this one from Don. Then we've got to call it a night, because I'm very conscious now. We're coming up to 10 o'clock. Hi, I'm 39. Will be mortgage and debt free in 3 months. Dude, come on. Now you're talking. Never is about having disposable income and whether it's worth using a lifetime ISA in stocks or shares to start off. Is it worth having a lifetime ISA age 39? If you are going to open a lifetime ISA, Dom, you have to do it before you hit the age of 40. So what you probably want to do is just go open one anyway. And if you use it, you use it. If you don't, then there's nothing lost. But if you are getting mortgage free in 3 months' time, um, nervous about having disposable income and whether it's worth having a lifetime ISA. So I'm guessing you want to put money away into the stock market. Um, I would imagine. I mean, what is it for? I mean, what is your plan, really, mate? I guess is the question. You're going to be mortgage free at 39, which is freaking awesome. It's amazing, by the way. But okay, but what do you want to do? Where do you want to go on from there? What's the goal after that? Do you want to acquire more properties? No, buy to lets, for example, that Steve was asking about earlier. Is that on your agenda, or do you just want to have maybe that disposable money that you're a little bit nervous about and put that into, I don't know, a pension or a lifetime ISA for pension purposes? What's the plan? It's kind of hard to say. Maybe give you a few things to think about. What does when have you sat down to pencil down and be like, okay, 39 years old, mortgage is going to be done in 3 months' time. You are going to have some disposable cash, but what are you going to do with it? What do you want to do with it? What do you want to build towards? What do you want to work towards? Do you want to launch your own business? What do you want to do? Because all of a sudden, like I already mentioned before, right? You're going to be looking at life in a very, very different way right now. You just said here, plan to feel comfortable at 55, mate. Well, you've got again 17 years pretty much, right? So what does comfortable mean to you? What does comfortable mean? If And this is something I used to do with advisors, right? You close your eyes right now and you try and teleport yourself to that day at 55 when you retire. Try and visualize it. Where are you? Where are you? Who's with you? Are you in a sunny climate? Are you here in the UK? You woke up in the morning, your first day of retirement. You want that comfortable lifestyle. What does that look like? What do you want to do? Do you want to go play golf? Do you want to go and have lunch with friends? What is it that you want to do? Try to contextualize it as much as possible. Try to visualize it as much as possible. The more detail you can put into answering that question will tell you what comfortable essentially means. Now, this is the reality, right? And when I was advising, and whenever I have this kind of conversation, even in coaching calls with people, and I ask, what does comfortable look like? Because the reality is there's a price tag to comfortable. And depending on how vivid your picture of comfortable is, will determine how expensive comfortable is for you. For some people, it's 12 grand a year. For other people, it's 60 grand a year. For some other people, it's 80 grand a year. What does comfortable actually look like for you? So try to visualize it. Who are you with? Where are you? Are you somewhere sunny? What do you want to be doing? What do you want to do the first day? What do you want to do the second day? Do you want to go traveling? What car do you want to be driving around in? Do you even need a car? As much context and detail of that is really, really important. When you know what that is and you can write it down, you can document it, then you'll know how much that comfortable is going to be. That will then tell you, okay, so based on my level of comfortability and what that means from a financial point of view, what I need to be doing from this point onwards, once my mortgage is paid off for the next 17 years, is invest X amount of money into lifetime ISA or pension, because I know that that's going to be able to generate me X amount of income to make comfortable possible at 55. And, whether you should be using a lifetime ISA or a pension, that is a big question as well. Pros and cons. Lifetime ISAs, you're going to get 25%, from the government, £1,000 for every £4,000 you put in, but you're capped at £4,000 every single year. If you want to amass a large amount of money, or you're going to need a large amount of money to help you sustain your retirement income, then a pension will probably be the better route to go down, because depending on your earnings, your allowance for a pension in a year is £40,000, so 10 times the amount that you could put into a lifetime ISA. Then add on to that the fact that, at 55, you could potentially, within a pension, assuming the legislation doesn't change, access a quarter of the money that you've amassed in your pension completely tax-free. You could take that, buy property with it, do whatever you want. So the details very, very important. Really, 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 really important. But you need a little bit more detail. You're saying on here, modest amount live on a modest amount in the UK. But what is modest? Modest means something to you. It means something very, very different to me. It means very, very different to someone like, I don't know, Lloyd, for example, in the chat. What does that mean? You need specificity. You need dollar amount, pound and pence. What does that number actually mean? Is modest 12K, 10K, 15K? You need to know exactly what that number is, because if you don't know what that number is, you can't forward plan and you can't take prescribed steps to get there. So I know that's a lot that I've just burdened you with, but try, again, detail, specificity. Like Conor McGregor said something. He said, if you can visualize it, like really, really visualize it, and you're bold enough to speak it, you can make it happen. For you, it's not necessarily speaking it vocally, it's putting it down on paper, but being specific. So, for example, when I was working Canary Wharf, and it was one of my ambitions to, get on the property ladder, I had a vision board. And on the vision board, I had 4 things. And those were the 4 things that really, when I was working, stupid hours a week, I was doing 70 hours a week. I was doing 70,000 miles per year at that point in the car every single day, doing ridiculous miles. And, this is going to bed at 2 o'clock in the morning, getting up at 4, 5 in the morning, getting on the road and going out. When things were really, really tough, it was, what was I working towards? And I had a picture of the house, as visualized as possible, very specific things, because that identity of knowing exactly what you want is what really, really matters. It brings it to life. £600 per month, you times that by 12. Okay, so you times that by 12, that gives you the amount that you need per month, well, per year, sorry. You've got to factor in your state pensions. Once you know what that amount is, then we got to do the calculation backwards to know how much you need to amass in the lump sum to get you £600 per month. Really, I know, very, very high level, very, very detailed, but make sure that you do that. Really, it's very, very important. All right, okay, an hour, 50 minutes. Appreciate you guys for being here. You know what? Robert's just made a really good point here. And again, like, it's not for everybody, but I do think that everybody should try to acquire the skill of being able to be as detailed when it comes to their own personal plans. I truly, truly, truly believe that. He's saying here, detail works for some people, other people hate detail. Both types can be very successful. In fact, some of the most successful detail will delegate all the detail to others. Well, that's easier to do in a business sense. It's very, very hard to do from a personal point of view, because how are you going to delegate what you want personally to somebody else to bring out? If it's a business, very, very different. You simply get someone with a skill set. Now, you could approach financial planning in a very, very business mindset and be like, I'm going to employ somebody to do X for me, employ a financial advisor, employ an investment manager, employ an accountant. You can do that. But they will still need to know the detail of what you're aiming for to make it happen. Same thing with so most people, they go into business, they have a business plan, right? Most people do. The plan for the business is in 5 years' time, we want to be here. We want to be selling X amount of product or have X amount of turnover. Okay. That high level detail then dictates everything that needs to happen within the plan to actually move towards that. It's exactly the same thing when it comes to personal. If you want to be here in 5 years' time in your personal life, okay, what are the steps that you need to work back to? On a personal basis, it's very, very hard to delegate that to somebody. And if you do delegate it to someone, there's nothing wrong with it. They're still going to need the detail. But only you truly know what you want to do and what you want for yourself. And just being able to document that, I'm a big believer in if the more detail you can put into it, gives you the ability to really lean back on the fact that I will guarantee you this right now, it will get hard sometimes and it will get extremely difficult and you'll want to quit. Having that granular detail allows you to key in to that one point of focus, and that is what takes you through the really, really difficult times. Like when you want to quit because it's really, really hard or things just aren't working in your favor. You know, you might have had someone do something that put you off your game and you just want to jack it all in. Having that granular detail, it's worked for me, may not work for everybody, but having that granular detail really, really does make a big difference. All right, guys, thank you so much for joining me. Again, these are going to be Sunday evenings, 8 p.m. now, because everybody voted. I think it was 48% or so in favor of an 8 p.m. start. We could probably spend a little bit more time without it being too late. But again, this is 2 hours of my time on a Sunday evening. And oftentimes I've got a load more stuff I need to do on a Sunday in prep for the following week. So yeah, 8 p.m. Issue 2 of the magazine comes out next weekend. So if you're not subscribed to that, head over to conversationofmoney.com. You can subscribe to the monthly magazine there, or it will also be in the first link in the description to this video. What else was I going to say? What else was I going to say? I was going to mention something else. Oh, yes. There are some updates on the channel coming on Tuesday. So please watch the video on Tuesday. And if you have any questions, feel free to ask questions of me there, or you can save them till next Sunday. But yeah, there's a pretty big update for the channel, which I've made a video on for Tuesday. But yeah, that's it. Have a good evening, everybody. Whatever it is that you're doing, I appreciate every single one of you. Thank you so much. I will catch you a bit later on.